Howdy, Jacob here. Today we're looking at Enersys in the electrical equipment industry, 4.2 billion market cap on 4.7 billion enterprise value. Founded in 1991 out of Pennsylvania, they engage in the provision of stored energy solutions for industrial applications worldwide. Their segment offers uninterruptible power systems for computer and computer-controlled systems. Their revenue growth is not crazy impressive. You're probably looking at 2 to 4% a year over the last 10 years. And there's a couple years in negative, but otherwise it is growing somewhat consistently. Not the greatest gross margin, about 25 to 28%, with an operating margin low double digits for the most part. So not a terrible operating margin. They do pay a dividend. They increased it last year, but outside of that, been paying the same dividend for the last 8 years prior. Return on invested capital averaging probably upper single digits. So nothing crazy impressive, but really not terrible. Balance sheet has 333 million cash on hand, 30 million short-term debt, 800 million long-term debt. That 800 million long-term debt in relation to their free cash flow. Again, we're saying this other line is going to be their CapEx. Sometimes Quick FS brings in things weird, but this being their CapEx, they probably average 300 million or so. So not terribly concerned with the 800 million in long-term debt, especially with almost 40% of that in cash on hand. And their use of cash is 2 big acquisitions here. Outside of that, a dividend that pays out not even 20%, and good amount of share repurchases and debt reduction. So majority of your money recently is going to debt reduction. However, you got 15 to 20% to a dividend, maybe a little bit more to share purchases, and then historically you've made some large net acquisitions, hopefully when it makes the most sense to do so. That's enough to get me to make some assumptions here. So on the revenue growth side, I don't think we'll be looking at really sexy growth, but I think that there will be some net acquisitions along the way, and I think that'll be able to get them to about 4% growth. For margins here, the average is about 5 and 6, and I'm probably pretty comfortable with that. I don't see a trend necessarily with their gross margin or operating margin that's telling me it needs to be higher, and so I'll probably go just in line with averages there. And for share repurchases, 1% is about 42 million, 72 million if we want to offset stock-based compensation, assuming all of those turn into shares. I think I'm comfortable with that one being 1%. Terminal, I think it's a fine business, not great, not fantastic. Growth is relatively in line with average. Let's do 14 there, 15% return. The dividend's not super big, but they've increased it the last couple or just the last 2 years, so maybe you'll increase it with the revenue growth figure, since again it is just a 20% or so payout. And right now we're saying it needs to fall a little bit more than in half before you get the return we're looking for here. So I think it's a fine business. I think if you understand this business very well and you think the margins are going to stay at this double-digit rate, then it could possibly be a buy price today. But until then, not for me. Hope you enjoy the video and have a great rest of your day.